Welcome up, Ticks. I'm Jake Falcon.
And I'm Corey Bittner. We're the founders of Falcon Wealth Advisors and your co-host for Upticks.
Today's our 42nd episode, springtime.
We're going to talk about margin, the S&P 500, and questions worth asking.
Forgive my casual dress today. I'm going to go play golf with a client today. It's a Friday that we're recording this on, and spring is in the air, and I'm going to go tee it up.
At first, I thought I missed the memo.
No, you can still wear a suit.
All right.
You can hold the fort down while I'm out there enjoying the sunshine.
Do it. You got it.
Okay, so for our first topic today, we wanted to talk about what margin is. And margin is basically a type of loan that you can use your securities in an after-tax account as collateral. And I wanted you to kind of go over with our audience some uses that we basically help our clients utilize their margin for.
Okay, so the idea, again, just as you described, it kind of explains what margin is. It's basically just borrowing against your portfolio. There's obviously an interest rate associated with doing so, right? So for us, our custodian is Charles Schwab, so our clients' assets are held at Schwab. The idea is if someone had $500,000 invested in their company stock, or maybe just invested period, not even necessarily in their company stock, they could borrow against that, so it gives them liquidity for a certain interest rate, but it wouldn't require them to sell their stock. So that way, if somebody wanted to either buy a home, put a down payment down on a home, buy a boat, give someone a gift, provide someone a short-term loan, whatever it might be, it provides somebody the ability to do that without selling securities, realizing taxes, and everything else.
Right, so let's kind of further define that because I think people get confused by it a little bit. So again, we're talking about non-retirement assets here. Mm-hmm. So if you have an IRA or a Roth IRA, margin does not apply.
Correct.
So this would be money that you've saved up. Maybe you have a trust account. It's after-tax money.
Yes.
And typically, you basically, on these types of accounts, you pay taxes as you go. And what we do for a lot of our clients in these types of accounts is traditionally we'll buy tax-free bonds,
right?
Or we'll have some company stock in there. Maybe we'll trade some options, a variety of things. But why wouldn't somebody? Okay, so let's do like a what if scenario. So let's say somebody has $200,000 in this account, and they want to, they want to buy a new car, okay, and they don't want to go through the traditional financing of the dealership. They don't like messing with that. They just want to pay cash for the car. What would you say to this person? Why would they use margin and not just sell some securities to pay cash? And let's say the car's, $40,000.
Okay. So if there's if there's $200,000 in the account, it would really come down to how that $200,000 is invested.
Let's say it's hitting an average return of 6%.
Okay. Perfect. So if it's hitting an average return of 6%, and let's say the margin available to someone, meaning they could borrow money on this margin that we're talking about, and their margin interest rate is 4%, the idea there is...
Now I want to tell you that's pretty typical too, which is actually that's not the case with a lot of other brokerage firms. Because of our relationship with Charles Schwab, our margin rates are a lot lower.
Correct.
Typical one that we are seeing out in the open market is what, closer to probably 7%?
No, it's actually between about 9 and 10%.
Really?
Yeah. If you were me or any just retail customer went into Schwab's office down on the plaza, for instance, and opened an account and wanted to use margin, it's between 9 and 10%.
Wow. But because of our arrangement with Hightower, who helps us with our back office support, they have negotiated that fee down for our clients. And again, Corey and I don't get paid this 4%. It's what Charles Schwab, our custodian, gets paid. Now, it is variable, so they have the right to increase it or lower it.
Correct.
But 4% is pretty darn cheap money, especially if your account is making 6 or 7%. But go ahead into your example here.
Exactly. So really to kind of, tie that all together to your point, if the car costs $40,000, you have $200,000 invested averaging 6%, or that's the target return, and you can borrow from that $200,000 at a 4% interest rate, you, the investor, the client, or whomever, is still netting out that spread of 2%. So in other words, you wouldn't want to sell securities necessarily that are making you 6% to go and buy something where you could have borrowed the money for 4%.
Exactly. And another reason that our clients do this is that they don't want to realize any capital gains.
Right.
So the idea by using margin is you're not selling anything, so you're not creating any tax liability. And then what we typically do is we'll use that dividends and interest to pay it off. Maybe we'll have an investment pullback that we can sell. Maybe a bond will mature. There's all different types of methods that we use to pay back the margin. The beauty is though that it's just accruing, so you literally don't have to make payments if you don't want to, but you certainly can do that as well. So it's just one way that we look at both sides of the balance sheet for our clients, and they come to us. I mean, we've had clients buy homes on margin, certainly pay their taxes with margin, buy cars. Can you think of anything else? Maybe give a gift to kids. I don't know, children, or
Yeah.
What else have you had
Like I
clients
said,
use margin for?
if they wanted, well, like you said, giving a gift to a child, but if they wanted to give somebody like a short-term loan.
Right.
If they had a family member maybe who needed money for a down payment on a house, but that family member was waiting until their house sold to get the
so
money
like a
back.
bridge loan?
Yeah, like a bridge loan, exactly.
Yeah, so there's all different sorts of uses for margin, and we like it because the current interest rate is still quite low, and so it can definitely make sense to save you from having to sell securities and pay taxes, and also maybe make a little bit more money, like you talked about. If it's only costing you 4, but your account's making 6, well then you're netting out that 2% difference, and we haven't had too many clients ever complain about making too much money.
Exactly. And then the last point that I do want to make while we are talking about this though is what is unique about it in our situation specifically is that, again, we talked about if we were to go to Schwab and open an account, our margin rate would be between 9 and 10%. There's also a lot of investment banks out there too that offer securities-backed lines of credit.
Sure.
But the idea though is that those spreads are typically higher too because
Those are closer to 7%. I
yeah,
think,
exactly.
right now.
Because the firm itself is getting compensated. Their spread is larger because they're making money. With this arrangement, we're not making money on it. Schwab just has to charge an interest rate to loan you the money.
Well, they want to make money.
Yeah, they need to make money.
Schwab's making money on it.
Yeah, exactly.
But we're not, and so that's what keeps the cost lower.
Exactly. So the way I see it is a securities-backed line of credit at a big investment bank is going to be in all likelihood more expensive than this, and just going to Schwab would be more expensive than this also. So that's why for definitely several of our clients, it makes sense at least to consider.
Yep. Very good. So that's margin. Again, if you have any questions, you can certainly reach out to Corey or myself directly. We're happy to walk you through it and explain exactly how that works.
Yep.
Okay, very good. So moving on to our next topic, the stock market's had a heck of a first quarter here.
It has.
And as it stands today, the S&P 500, as of the recording of this show, is up around 16 or 17% on the year, which is typically not sustainable. I mean, if we kept on this trajectory, I mean, you're talking about a 45% or so rate of return on the year, which again would not be normal. So I wanted to get your thoughts are, where do we go from here? Where's the market headed?
I wish I knew. I could tell you exactly
Right.
where it's headed. I believe, though, from things that I've read and research that I've done, that interestingly enough, the correction that occurred at the end of 2018.
Right. So the fourth quarter, the market was down around
Nearly 20%, yeah.
19% or so.
The idea is that is a reset of things in a way, and it's actually, once that occurred, your future expected returns are higher once the market actually pulls back. So what's interesting about that is we've seen obviously things come back, and it's been pretty strong as a recovery here, but the idea is if you look at years in which the market has done what it did in the first quarter of 2019 and then looked at future returns over the next 12 months, believe it or not, that kind of strength typically leads to more strength.
Really?
Which surprised me. Because I know there's a lot of people that have asked me questions. We hear the talking heads on TV all day saying, well, the market's already up, 17%. Now's a great time to sell all the stocks in your portfolio because inevitably it's going to go down. And sure, it is going to go down at some point, right? But we don't know when.
Right, you can't time it. For example, it bottomed out on Christmas Eve, and
Yes.
if you sold out of everything because you were scared, you would have missed out on this huge bounce back.
Correct.
Right, and then January was a good month. So if you would have sold out then, you would have missed out on February. Right,
Exactly.
and then March was a good month. So if you would have sold out in February, you would have missed out on March. So, but you're saying because of this bounce back and the resetting of everything, that it should have some more momentum and be
Yes,
stronger?
Exactly. And what's also interesting about that too, and the kind of last point I'll make on that, is because the recovery in the market has been very broad. Meaning, since that happened at the end of
Right.
2018, it hasn't been just a handful of sectors leading the market higher, where it hasn't been just technology or just energy or whatever it might be. It's been a pretty broad recovery, which historically speaking has actually led to more strength and more momentum.
Gotcha.
Positive momentum.
So we're sticking with our strategy as far as selecting individual stocks for our clients. We don't outsource that. Well, one thing that we are doing though is we are rebalancing.
Yes.
So we might not be getting out of stocks altogether, but if you have a stock that's maybe up 30 or 40%, this year, we are selling some of those shares and putting it back into an individual stock that may not have done quite as well.
Yes, I was just talking to Jesse this morning before we recorded.
Who's Jesse?
Our investment analyst. And last week is when options expiration occurred for the month of April. So this week there's been a lot of rebalancing in clients' portfolios. And he had mentioned that there was some stocks that are up over 50% since the beginning of this year.
It's fantastic.
So it's a great time to be rebalancing, to your point.
Yeah, and we're very proud of that. So again, that's why we do the research in-house. We're not outsourcing this to a third party like a mutual fund or an index fund or even another money manager. We take pride at Falcon Wealth Advisors that we're doing that work on our own. That's why our staff is bulked up a little bit. We've got more probably people in a traditional team of our size, but we're doing that because we feel that we're providing more value to our clients because we can point to each one of their stocks, each one of their bonds and say, we picked that for you and this is why it's in there. And a lot of advisors can't say that.
Correct.
And we, as fiduciaries, we're legally obligated only to act in our clients' best interests, and that's why we're doing that.
That's right.
All right, very good. So we'll see. I mean, again, your guess is as good as mine as to where we're headed.
What's your thought?
Well, pullbacks happen. Again, I'm not going to.
Sure.
I'm not going to be a fool and try to time it. Pullbacks happen. I think we're being prudent and that we're rebalancing.
Agreed.
I think we may start shifting the portfolio a little bit more defensive. Again, not getting out of stocks, but we might look at some of the other sectors. But I don't know. I mean, historically, a 10% pullback happens once a year, so I wouldn't be surprised if that happens. They typically say sell in May and go away, so I'm interested to see what the summer looks like. But again, I don't know. I know the economy fundamentally looks strong. Unemployment numbers are great. GDP has come out here. That's gross domestic product has come out and been really good here lately. So like I said, fundamentally things look great. I'm going to be interested to see now that the politicians are going to start gearing up for the next presidential campaign.
Can't wait.
Well, that actually might be a good thing for the market because they'll probably stop doing things that will disrupt Washington, and they're really just going to try to win votes. And I think that's actually a good thing for the market. So we'll see how it plays out. All right, good. So for our third topic today, I wanted to go into our questions worth asking segment, and I'll let you go first this time. Why don't you go ahead and ask me a common question that you've been hearing from clients lately?
The question I wanted to ask you is maybe not a common one, but it's a good one that I was just asked yesterday.
Fire away.
So I just met with someone yesterday who asked me, he said, I was reading in the Wall Street Journal that Charles Schwab, where you guys hold your clients' accounts, just came out with a new way of charging investors fees for investing. And it's a subscription-based model. And his question for me was, if the idea there is to lower costs to investors or to clients, is that something that you and Jake talk about? Is that something that you guys think about? And what do you think the way that investors or clients pay fees looks like moving forward?
It's a very interesting and a hot topic, and something that actually I look at very closely in research because the industry is evolving, and there's a lot of different ways that advisors charge. I think the old school way that you get at these big banks of charging commissions is definitely something that shouldn't be done anymore. But it is interesting. Do you charge a percentage of the assets? Do you charge an hourly rate? Do you charge a subscription rate like the Netflix model?
Yep.
There's all these different items. One thing, the Charles Schwabs of the world and the Vanguards of the world, so while we use them, we're an institutional client. We use them as our bank because there's $3 trillion over there. We want to have that big safety net. We also actually compete with them a little bit because they do have financial advisors at a call center. Now, the big difference though between a Charles Schwab call center and us is that, if you put your money with them and you're charged a monthly rate to talk to a licensed professional, they're not going to know you from Adam.
Right.
They might be managing thousands of clients, and then, you might be you're not going to get the level of sophistication.
Right.
And certainly not the customization that we provide with that. So it's kind of like, we're probably like your more higher end restaurant where they're going to more than likely remember you. They're going to, when Mr. Bittner comes in, they're going to unfold your napkin and, just really cater to your every whim and make it more about a personal experience. Whereas maybe the Charles Schwabs and the Vanguards of the world are more like fast food restaurants, right? So they're catering to more people. It's very cheap. The quality might not be there, but in the end, you still get fed. And so for us, we feel that, we really don't compete with them, frankly, because our clients aren't looking for a cheap, fix. They don't pick us because we're the cheapest advisors.
Right.
There's actually tons of advisors in Kansas City that are less expensive than us, And there's tons of advisors that are more expensive than us. Again, our clients choose us because, we shoot them straight. You and I particularly have focused our education on retirement planning. And we're fiduciaries, and I think it's a lot about relationship. Again, I'm going to go play golf with a client. You're not going to get, and I'm going to get to spend 4 or 5 hours getting to know my client better and helping develop that relationship. And in turn, I'm going to be able to provide him better advice than if he just called a 1-800 number and I didn't know who he was.
Exactly.
So I know it's a long-winded answer to your pretty easy question, but I don't know. Did I cover all the bases that you probably covered with your client?
Yeah, for the most part. The only thing that I want to add that I think is interesting, and I think you and I have talked about this before, but I talked with him about this yesterday too, that in theory, let's say that the future looked like we were compensated by our clients on a monthly basis instead of, typically the way it's set up where it's based on the value of someone's assets. The question that I posed to him, which we both agreed kind of made sense, is if somebody's getting paid the same dollar amount no matter what, what does that do to their incentives to grow the account? Right, if they're managing the money themselves. Right. If I were a client, I don't know how I would feel about paying the exact same dollar amount no matter what. So if the market went down, I'm still paying you the same. I don't know if I'd like that.
Well, that's a good point, though. That drives a really good point. So because you and I are managing the investments in-house, we should be getting compensated on the value of the portfolio. Now, most financial advisors don't do that. So I would argue that you should not pay a financial advisor an asset-based fee if they're not picking the stocks and bonds.
Interesting. So you mean if an advisor was going and buying mutual funds or exchange-traded funds?
Yeah, they should be getting paid, I don't know, $50 a month or something because they're not managing the assets. The mutual fund is managing the assets. So I think if that's the way the industry went and that was more popular, we would charge a subscription fee, but then we would just let a third party manage the money. We would stop doing that. But that's not what we want to do, and we're not certainly going to do that. But if that was the case, we wouldn't manage the money then. Because again, we only want to get paid for what we're doing. And so we're doing all the financial planning, we're giving all the retirement advice, and we're doing the investment advice in-house.
Right.
And that's what our clients are paying for. If we're using a mutual fund or annuity or even an index fund, we shouldn't be getting paid anything for the asset management. Because we're not managing the assets.
That's an interesting point, but it's probably a good one.
Yeah, so that's the way I see it. And I read a lot about this, and I think we're compensated fairly. Our typical fee is around 1% of the account value. It can go higher or lower based on the size of the account.
Right.
But again, that covers everything that we're doing. All 8 of us on our team are supporting our clients. And I think that's fair for today. But again, obviously the industry is changing, so we'll see how that goes.
Yep. I just wanted to throw that out there because I thought it was an interesting question, something that I don't get asked very often.
Yeah, it's a very good question. All right, so the question I had for you was, let's say a client is retiring and they're 60 years old. What do they do about health insurance?
That's a good question. So if we are operating under the assumption that someone is retiring, they're obviously not Medicare eligible age yet, which is 65, and they're not covered by benefits by their employer, as it stands today, it looks like the Affordable Care Act exchange, right? Going and obtaining private health insurance is the primary option that most people utilize. And we have, as I'm sure we've talked about before, we have a contact of someone that can help our clients with that. But if someone I would also say maybe from a financial planning standpoint, that's something they need to be thinking about too.
Right.
Because that cost might be greater than what they were used to from when they were working.
Yeah, absolutely. So definitely something we have to budget in the financial plan. We typically will refer them to another professional that owns that arena. We want to bridge that gap till Medicare, till 65. Medicare's not free, but the cost does typically go down. Not always, actually, but it typically does go down. But yeah, that's something that we plan for our clients. Certainly nobody typically likes paying more for their health insurance, but the way we see it, if you're 60 years old and you want to retire, is it really worth working 5 more years just to save a few $100s a month? I mean, that might not be the case. If you want to go travel the world and spend time with your grandkids, or certainly go play golf or whatever that may be, we want to weigh the pros and cons of that. I just met with a client. Things are changing at his job, and he doesn't feel like he's being appreciated or valued like he used to be. And so we put health insurance in there as a goal. He can afford it, so he's going to retire. And that's it's really about quality of life. It always isn't about dollars and cents. It's really about what am I getting out of my day-to-day life, and am I valuing my purpose, and am I enjoying myself? And that's really what our jobs are to do.
Yep, I feel like I've had a similar conversation with several people over just the last few weeks where We talked about that health insurance cost, and while it might not be something that you want to spend your hard-earned money on, the fact of the matter is, if you can afford it, and then you can go and live the life that you want to go live, it's not so bad.
Right. And so again, that's part of our advanced planning that we do. Again, you and I being chartered retirement planning counselors, it's a big deal. Something that we're happy to talk to with our clients.
Yep.
All right, good. So for our fun global topic today, I know, I feel like there's been a lot of TV shows on lately. I know you're a Game of Thrones fan.
I am.
As of the distribution of this video, it would have been, my wife's really pumped about it. They're going to have the longest running battle scene of all time in any movie or TV show.
And do we think that's the next episode?
Yes, that's what she told me at
Okay,
least.
all
And
right.
so, so what are you thinking of the final Game of Thrones season? Is it living, without any spoilers, is it living up to your expectations?
In my opinion, I suppose so, yes. I think the first two, it's only 6 seasons, or I'm sorry, so only 6 episodes.
Right.
And
So they've had 2 so far. It'll be the third by
Yes.
the time this goes out.
And the first 2 were just, in my opinion, mostly setting things up.
For this battle, right?
Yeah, and I think for the next several, because what's interesting about it is the next 4 episodes, the final 4, are like an hour and a half long each. So they're each almost, maybe not quite that long, but they're
Wow,
each
it's
like
like
a
4
movie.
movies.
Exactly.
Yeah, wow.
So I think they spent the first 2 were the sort of regular hour, 50-minute to an hour-long episodes, setting things up, and I think the next 4 is when somehow, some way, they're going to have to figure out how to tie everything that's happened
Right.
together.
Yeah. So I never got into Game of Thrones. I missed the boat, and then I felt like I was so far behind that it wasn't worth catching up.
I was going to ask you, is it just a lack of interest?
Yeah,
or
no,
you
I
just
don't.
sort of missed the boat?
My wife thinks I'd love it. I just never got into it. I missed it, and I felt like I was too far behind.
Yeah.
Kind of like Sopranos too. I want to go back and watch all the Sopranos.
Mm-hmm.
I watched them a little bit, but then again, I felt like I got behind, and so it was just a little daunting. I don't know. Maybe that's just me. I don't really binge watch.
Yeah,
So it's hard for me
yeah.
to catch up. I try to watch 1 or 2 shows a week really, and the rest of the time I'm working or reading or spending time with my wife. But
Right.
I'm really into Billions just because it's around the financial markets. I think they've done a fabulous job with that show. I think it's pretty fun. There's lots of twists and turns, and the plot kind of goes around. I don't know how many seasons they're trying to get out of this thing.
What season is it in
I think
now?
it's in the 4th season,
Okay.
and it's been really exciting. Again, it's fun for me because it's has to do with financial markets, and that's why I enjoy it. And I think the actors do a really good job of that one. So that's kind of my favorite one right now. Do you have any other shows that you could share with our viewers that you think are good, that you're enjoying?
Not really. I mean,
Don't you
admittedly,
watch that?
there's-
It's Always Sunny in Philadelphia?
Yeah, yeah.
Is that a good one?
I think it's pretty funny. I mean, the group of people that's on there is the whole concept of the show is the characters are really not the best people, and they kind of just manage to get themselves into trouble each and every episode.
haven't
But it's
seen
been
that.
going for a really long time. I think it's on maybe the 14th season
Whoa.
comes out this year. Yeah, so it's been going
Jeez,
for a long
that's
time.
a long time.
So yeah. I get a kick out of it. I think it's funny, and it's like 20 minutes long, so it's easy to watch like an episode or two. That's what I like about it.
Gotcha. So that's our fun topic. So it's good TV watching.
Yeah.
Springtime is in the air. I know you're a big tennis guy, so you'll be getting out there playing tennis. I'll be playing a lot of golf this year.
That's right.
But again, as always, thank you so much for tuning in. This is about all the time that we have for today. Please feel free to subscribe to our YouTube channel.
Yes.
You can certainly find us on social media. We're on Instagram, Facebook, LinkedIn, Twitter.
All of them.
Yeah, basically not all of them. We're not on
Close to all of them.
Snapchat,
Fair
I
enough.
guess. But please subscribe to our blog. You can go to our website to do that so that you make sure and get every Tuesday morning we send out an email that has our latest blog by Jesse, our investment analyst. We'll typically have this show on there along with our podcast, and then you'll kick out one of your blogs on retirement planning as well.
Which, sorry to interrupt you, one thing I wanted to talk about here while we're kind of summing this up, I've written a little bit about this, so if anybody follows along and has seen us out there, I've started writing I've kind of taken on this retirement questions answered series that I've started writing, and my goal is to write about the top 100 retirement questions that people have and answering them. So if
great.
anybody has any thoughts or ideas or specific questions that they'd like to see or hear or read about being answered, please feel free to email them to me, tweet them at us.
You can't
whatever
be
it
out
might
of questions already, though. How many have you written
I've written,
or answered?
well, I guess I've answered close to 20.
Wow. And you're out of ideas?
No, not about, I have about another 10 in the queue, but my point is I'm coming up with the questions, so I
and
want
we
to hear
wanna
what people are interested
Yeah,
in.
exactly. So shoot Corey an email, Corey at falconwealthadvisors.com. You can find him on Twitter.
Yes, I'm on Twitter at Corey Bittner KC, and you're on Twitter.
Yeah, Jake Falcon, CRPC. So that's kind of a fun project Corey's kind of embarked on. He's a good writer. He enjoys it. So you certainly can find all of that on our website at falconwealthadvisors.com. Thanks again for watching, and we hope you all have a great week.